Imagine an individual earning a respectable $52,000 a year. She is the model of financial discipline, setting aside a portion of her paycheck every single month without fail. She isn't chasing the latest meme coin or trying to outsmart the market through day trading. Instead, she has parked her savings in a diversified index fund. 5 years into this journey, she decides to check her progress. She has diligently contributed $30,000 of her hard-earned money. She looks at the total and sees that the market has added roughly $6,700 in gains. 5 years of patience, 5 years of sacrifice, and the magic of compounding has yielded $6,700. This is the side of the wealth-building story that rarely makes it into a viral social media post. These are the invisible years, the period where your money is technically growing, but functionally it feels stagnant. We are often sold a dream via a beautiful, upward-curving chart that promises a mountain of gold at the end of the rainbow. However, those charts rarely label where you actually are on that curve. They show you year 1 and year 30, but they gloss over the grueling decade in between, where you are doing 90% of the heavy lifting. The myth of the doubling penny. You have likely heard the classic riddle: would you rather have $1 million today or a penny that doubles every day for a month? By day 30, that penny is worth over $5 million. It's a fantastic way to illustrate geometric growth, but there is a major problem. It's a fantasy. A penny doubling daily represents a 100% daily return. In the real world, the stock market averages closer to 7% to 10% annually before inflation. After inflation, you're looking at perhaps 6% or 7%. At low balances, that 7% return is almost imperceptible. If you have $1,000, a 7% return is $70, barely enough for a decent dinner out. This is why the early stages of investing feel so demoralizing. You aren't watching a penny double. You're watching a penny grow by a microscopic fraction of a cent. Meet Sarah, a real-world case study. To make this concrete, let's look at Sarah. She is 28, working as a marketing coordinator, and earning that $52,000 salary. After taxes, she takes home about $3,380 a month. Sarah decides to invest $500 monthly, nearly 15% of her take-home pay. This isn't just extra money. Sarah is making real sacrifices. She's choosing home-cooked meals over expensive takeout and skipping luxury vacations to fund her future. Let's track her progress using an average 8% annual return. Year 1. Sarah puts in $6,000. The market adds $225. Her total is $6,225. Her reward for a year of discipline is $18 a month in growth. That doesn't even cover a premium Netflix subscription. Year 3. After 3 years of perfect consistency, she has contributed $18,000. The market has added a total of $2,268 in gains. Sarah could have earned that same amount by working a few weeks of overtime at her job. Year 5. Sarah's portfolio sits at $36,738. She has physically deposited $30,000. The market has contributed $6,738. At this stage, Her deposits represent 82% of her wealth. 5 years in, Sarah is still the engine. The compounding is merely a passenger, and a quiet one at that. This is the breaking point. Most people look at these numbers, feel insulted by the low returns compared to their massive effort, and quit. They assume the system is rigged, or that they started too late. But they are missing the shift happening beneath the surface. The crossover point, when the money takes over. The most important metric in personal finance isn't your rate of return, it's your base. 8% of $6,000 is only $480, but 8% of $100,000 is $8,000. The rate stayed the same, but the result changed because the foundation grew. There is a specific moment in every investor's life called the crossover point. This is the year when the market's annual growth on your portfolio exceeds your total annual contribution. Before this point, you are the engine. After this point, the portfolio becomes the engine. For Sarah, this shift happens in year 10. By then, her portfolio has grown to over $91,000. That year, the market adds $6,758 to her account, while she only contributes $6,000. For the first time in her life, her money is outworking her. Once you cross this threshold, the math turns into a runaway train. Year 15. Her portfolio is at $173,000. The market adds $13,000 in a single year, more than double her annual contribution. Year 20. Her wealth hits nearly $295,000. For the first time, more than half of her total net worth, 59%, came from market gains, not her labor. Year 30. Sarah reaches $745,000. She only put in $180,000 over 3 decades. The market did the rest, adding over $500,000. The magic people talk about is real, but it only shows up for the final act. Why most people never reach the mountaintop. If the math is so certain, why do so many people struggle? It's because life rarely happens in a straight line. When an emergency strikes before you hit the crossover point, it doesn't just slow you down, it resets your timeline. Let's say in year 4, Sarah has a $8,000 medical emergency. She has no choice but to pull that money from her investments. That single $8,000 withdrawal seems small, but it's radioactive. Because she removed it during the flat years, she robbed that money of its most productive future years. That $8,000 withdrawal delays her crossover point by an entire year. By year 30, that single $8,000 loss has blossomed into a $63,000 gap in her final balance. This is the reality for millions of households. They spend their entire lives on the flat part of the curve, draining the account for cars, house repairs, or job losses, and they never allow the base to reach critical mass. How to accelerate the journey? If the early years are a grind, how do you get through them faster? There are 3 levers you can pull. 1. Income is the accelerator. Below the crossover point, your ability to earn more matters infinitely more than your ability to save. If Sarah could increase her monthly contribution from $500 to $700 through a side hustle or a promotion, she wouldn't just have more money. She would hit the crossover point years earlier. You cannot frugal your way to wealth when the gap you're trying to bridge is 6 figures wide. You have to earn your way across the flat part of the curve. 2. Protect the base. The emergency fund. An emergency fund is not just boring savings. It is the structural support for your investments.
Its only job is to stay liquid so that you never have to touch your investment portfolio. By having 6 months of cash in a high-yield savings account, you ensure that Sarah's $8,000 emergency stays an $8,000 problem rather than a $63,000 catastrophe 30 years later. 3. Measure the right milestones. Stop looking at the percentage of growth in the first 5 years. Instead, track your savings rate and your total base. Celebrate the first $10,000, the first $50,000, and the first $100,000. These are the pavement of your runway. The plane doesn't take off at the start of the runway. It takes off at the very end. But every foot of concrete you lay down is essential. Final thoughts. If you are in the first few years of your investing journey and you feel like you're going nowhere, understand this. You are doing the hardest part. Laying the foundation is grueling work that offers very little immediate feedback. You are pushing a boulder uphill. But once you reach the crossover point, the boulder starts to roll on its own. The goal isn't just to invest for the long term. The goal is to build a base large enough that the math finally starts to matter. Stop staring at the curve and start building your runway.